good morning. I've got about 4 minutes for that to still be correct. So firstly, I must say it's actually quite a warm feeling when you walk into this room and you see the diverse representatives across the different parts of the value chain. I've attended a few of these before, and I think it was pretty much, all you'd see was just dealers. And I think to be able to see representatives from NAMSA, to have Martina here, to see some of the other manufacturers here, I think just really talks to how far as an industry we've come in the concept of collaboration. But I think more importantly about actually fully comprehending the fact that to be able to solve for the industry issues, we're going to have to work together. Okay, so if you solve for issues in your vertical, folks, we're in trouble. Right, but I'll talk a little bit about that a bit later. Just before I get to my to my preso, which I've had to change after this morning for various reasons. I mean, it's not for me to agree or disagree with the presenter, but I just think it's probably important that we must give color to what we deliver as well. We all have access to multiple, and I'm not sure where Davi is, we all have access to multiple points of data, and subsequent to the conversation earlier, I've made a call to my economist to come and join me here on stage. I want to see what he says, because from the points we see, I think there's a number of things that are trending positive in the economy. And I think I agree with a lot of the context that was provided, but I think there's more context needed to be able to almost give you a sense as to where we are as a country. And I think there are a number of aspects that are related to ideology. I've got a number of views I can tell you about the ruling party. I've got a number of opinions I've got about the opposition. That's not the point. The point is, as South Africans, and I don't know about you, I know about myself, I don't have option B. This better work. Okay, and so South Africa, no one is coming to save us. Make no mistake. Okay, so if you're thinking that when you go to the US, they're standing and they're saying, listen, South Africa is option B, they're not. Europe is not saying South Africa is option B. So as South Africans, we've got to figure this thing out. And I think we have gone through a number of challenges. Please don't hear me incorrectly. We have got a lot of problems. But in the midst of that, there's a lot of good things that are equally happening. And we will touch a little bit on some of those aspects that come through. So I just thought to share to say, I think the conversation from my perspective and my colleague here is to reflect where the auto industry is, some of the global trends, but how we can actually, from Martina's conversation, take advantage of where the industry is going and be able to grow. The politicians must deal with the political stuff. There's definitely implications, there's definitely impact, but there's a lot of stuff within our control as well. And I think, when I listened earlier, I thought there's a reason why this conversation was not on the third floor of any building, because I did look to go jump earlier on. It was a bit concerning, and I mean, I am a chicken licking eating kind of guy, so I think if Kentucky is a problem, so bankers eat chicken licking. So when I do speak, don't judge me on my meal. All right, okay, so let's go. Let's start.
Imagine you were able to ask a seed why it didn't grow. And imagine the seed talked back and said, changing was too hard, so I just remained. Like the seed knew that in order for it to become a tree, this version of itself had to die and take on a new form. So you tell that seed, listen, you've got greatness in you. You haven't even seen the best part yet. And you take that seed and you plant it in the right environment and you water it and you expose it to the sun and you remind that seed, if you don't change, you will surely die. And yet, you cannot make that seed grow. Now imagine you're the seed and I'm talking to you. What areas in your life have been planted but never grew? What changes have been too uncomfortable for you to make? Because your growth will not happen in any season of comfort. Growing is hard because dying to self is hard, but dying to stubbornness is even harder. I want to remind you that there is greatness in you, but you have to dig, prune, weed, and water your soil for your seeds to grow. To dig is to be honest with yourself. To prune is to remove old friends. To weed is to remove distraction. To water is to curate your environment. And the sun will bring out what's already inside of you.
Right. So, let's remove distraction. There's a lot going on. as an industry, as a country, we are contending with a lot. I've kind of themed it, are you navigating or are you surviving? I think Davi spoke about speeches being written, mine is also written. So if I do lose the plot a bit later, you'll understand that when we put these things together, we try and marry a number of pieces across the different aspects of the value chain. And so as we talk a little bit later, we talk about with navigation comes a proper understanding of what's happening today, but more importantly, what's still going to happen. And where are you positioning yourself to be able to better succeed or come out better than some of your colleagues. And then surviving is really that, just keeping head above water. In this economy, that's also good enough. Okay, so in some cases, we'll say, if you can make it here, you are actually doing good enough because it is actually quite tough. Why is this? I couldn't fill the slide anymore with some of the stuff that we're contending with. Okay, we've spoken about the economy, slow growth. It's going to be there for a while. High inflation. It's going to be there for a while. High interest rates. We talk a little bit about the interest rates coming down. We're expecting 25. It's nothing compared to what we've seen going up. Okay, so even when we do get the reprieve, 125 at best is nothing compared to the 475. So what does it tell you? There will still be pressure in households. That's not going anywhere. You talk about geopolitics, Trump version 2. We'll unpack that a little bit more, but Trump version 2 is a different beast compared to Trump version 1. Now, what you've got to understand is 20th of January, 2025 is when this man went into office. It is the 13th of March. And everyone is already talking about the Trump impacts and the ripple effects of that into the term. So you can understand that you're not talking about someone who is not going to have a major impact. But we'll unpack that and we'll talk a little bit about what that looks like. The Asian invasion. Guys, it's not stopping. Okay, so if you look at what's happened in this market in the last 10 years and what the Asian brands, and when I say Asian, I'm not only talking Chinese, I'm also talking Indian brands that are coming in. I'm talking about the relationship between German manufacturers, Japanese manufacturers with India. So the actual interactivity is becoming a lot more pronounced. Again, playing into this topic of the importance of geopolitics. Electrification, Martina here spoke a little bit, but we'll touch a little bit about that. And then lastly, I'm not going to talk to all these topics, is what does the regulatory landscape look like? But over and above that, when we talk about data and AI, do we equally appreciate that there are issues that are secondary which talk to the security elements? Okay, so what are the risks that come with being able to play in this space successfully? Okay, so if you think about it, 15, 20 years ago, what you'd worry about is someone literally, not that it's changed, walking up with a knife and saying, I want everything. Now you lose everything seated here on your phone or on your laptop. And as you send an invoice, do you understand the risk? So we'll unpack that a little bit later. Let's just start off with Thanda. I've asked Thanda to come and just maybe give a few minutes on where we see the macro kind of economics landing, but more importantly, how we synthesize this with where the market is. So I'll come back just after Thanda and kind of maybe just pick the pieces up. T.
Thank you so much. I don't have a watch, but I think it's still good day, it's fine. So I think I'm always cautious about how I talk about the economic story of this country and how government manages the economy of this country. Because whatever we say as economists could actually immediately trigger negative reaction from investors and potential investors. So it's really very important for one to be very careful. And I think there's a lot of successes that one can talk about what government has done over the years since 1994. I grew up in the villages. I never thought that one day I would be standing in such a big crowd presenting on economic outlook. So I'm one example of what government has done in this country in terms of improving socio-economic outcomes. And if you look at the South Africa's middle class, it has grown quite significantly. The black middle class, it has grown quite significantly. So there's a lot of successes. Electrification has also happened. Where I grew up, there was no tar roads before 1994. Now there's tar roads. So there's a lot of good things. Schools have increased, universities, access to universities. There's a lot of good things, but there are failures as well that we can talk about. But I think it's just important for us to to be careful how we frame our discussion about South Africa's economy. As far as the budget is concerned, I think, yes, there are instances where government kept on pushing the peak or the stabilization of debt each and every time they present. But if you look at the budget from 2023, government has always emphasized that they want to stabilize debt at 2025, 2026, and that has been the case since then. And that is going to happen. They've done that, they've said that yesterday, and I think that is going to happen. When we look at our analysis, we think that that is going to happen. So government is going to manage to stabilize that at 76.2% of GDP in the next financial year, which is 2025, 2026. So if you just look at the budget, there is a lot that you can pick up there that indicates that government priorities are actually shifting. Over and above that, there is a lot of economic reforms that have taken place, particularly under Operation Vulindlela. That started before the government of national unity, and that those reforms are going to continue under the government of national unity. So I think there is a lot of good things that are being done. But back to the economy now, and my presentation is structured around the global view and then around the domestic economic outlook. I think Ghana has indicated that since Trump came into office on the 20th of January, there has been a lot that has happened in terms of tariffs. I think some of them were effective from yesterday. He has implemented 25% tariffs on Canada, Mexico, China as well. I think so far now we've got, so in January he indicated 10%. Now there's another 10% on top of that. So since he came into office, there's about 20% on China's on U.S. imports from China in terms of tariffs, and also there is also tariffs 25% on products of steel and aluminium. So there is a lot happening in terms of Trump 2.0, unlike what happened in Trump 1.0. I think Trump 1.0 was largely focused on China, but this time around it looks like Trump 2.0 is focused on almost every country that has a significant trade deficit with the US. But what is important, if we just look at the chart on my right-hand side here, which is your left-hand side, this one, you can see that there's different exposures in terms of countries into the US. If you look at Canada, you can see their exports to the US is about 78%. So they are largely exposed to the US, and they export about 22% to the rest of the world. If you look at Mexico, about 80% of their exports go to China, to the US. Whereas if you look at China, about 15% of their exports go to the US. So you can see the degree of exposure is not the same, and therefore the impact of these tariffs across these countries is also not going to be the same. So I think that just gives you a context. We've also seen some estimates by the World Bank in terms of how these things are actually impacting the global economy. Firstly, what is happening in terms of tariffs is actually elevating global economic uncertainty, and there's an impact to economic growth on that. Secondly, tariffs themselves are negative for economic growth, and the World Bank has estimated that a 10% increase in global economic policy uncertainty has a negative impact on global GDP as well as emerging market and developing economies, excluding China. So you can see about 0.12% on the world economy and about close to 0.2% on emerging market and developing economies. So elevated global policy uncertainty is not good for the global economy, which is why we think that what is happening from a Trump perspective clouds the global economy and also the domestic economy, because we are interlinked to the rest of the economy as a small economy. But also they've estimated the impact of a 10% increase in US tariffs on global and emerging market growth. You can see there the impact is quite big with retaliatory measures and less so without retaliatory measures. So you can see global growth is down by about 0.3% when there is this trade war taking place, and by about 0.2% or about minus 0.18% when there is no retaliation in terms of tariffs. So the broad story here is that these things are really negative for the global economy, and here we're talking about 10%. So far, Trump has implemented 25% on Canada, Mexico 25% on product of aluminum and steel. So you can see the impact could be actually, the real impact could be actually bigger than this. But I think what is positive is that the latest projections from the IMF indicate that the global economy is still relatively in a good position, expected to grow by about 3.3% between this year and next year. Yes, this is still lower than what happened in terms of pre-pandemic decades, where we saw global growth growing by about 3.8, 3.9%, but it does reflect the fact that there is a delayed impact of higher inflation and tighter monetary policy, but also issues of rising protectionism, declining or aging population, particularly in advanced economies. And I think Davi spoke about that. Ongoing geopolitical tensions. So all those factors are actually weighing on global GDP growth, constraining global GDP growth from rising above pre-pandemic averages. But nevertheless, the fall in inflation and the easing in interest rates is expected to support this kind of economic growth that the IMF expects over the forecast period. If you look at what has happened in terms of inflation at a global level, a lot of progress has happened as a result of tighter monetary policy. Inflation is now closer to targets in most of the economies. If you look at the share of economies with headline inflation still above targets, that share has actually come down quite significantly. And that has assisted with some global central bank starting to ease interest rate. We know already that the Fed has already eased interest rate by 100 basis points. Yes, in their last meeting, they decided to pause because they want to assess the impact of these tariffs on inflation. So they are not in a hurry to cut interest rate, but our view is that they will still continue to cut interest rates and leave them at around 3.7%, which will allow us to also do the same here at home in terms of monetary policy easing. So when we come closer to home, I think there are challenges that the South African economy is actually experiencing. Firstly, we have elevated levels of unemployment at about 32% official unemployment, and it's even worse when you look at the youth unemployment above 60%. Our inequality levels are also worse. If you look at the Gini coefficient at about 65%, the worst in the world when you compare us to other peers. If you look at the percentage of our population that lives below the poverty line, about 40% of our population live below the poverty line. So there are structural constraints that are keeping the economy or socio-economic indicators in a relatively worse level. If you look at GDP per capita, it has actually regressed over the years, now sitting at close to 2007 levels. And our gross debt has actually increased, sitting at around 76%. But as I said, what is positive is that government is working hard to make sure that debt stabilizes, and not only stabilizes, but begins to fall beyond 2025, 2026. And what is positive is that the formation of government of national unity is also determined to make sure that all these social-economic indicators improve. So they want to increase, they want to boost economic activity through implementing economic reforms and through investing in infrastructure. And I think the budget does indicate that government wants to strike that balance between growing the economy and supporting the poor and vulnerable households. So these indicators, yes, they will take time to improve, and they are structural, but I think they're going to improve ultimately. And that is going to be positive for the economy, because what we need is inclusive growth. So if without inclusive growth, I think you're not going to have those positive spillovers into the automotive sector. And you'll see some of the chart that I will show indicate that majority of households, in terms of their income, they earn less, and as a result, it's not possible for them to afford some of the vehicles that are out there in the market. But there are also good things to talk about when it comes to the South African economy. It's a diverse economy with a variety of sectors, primary, secondary sectors, that are doing relatively well. Yes, there has been challenges over the past few years related to structural constraints, electricity, logistics, but those government is working very hard to try and improve the situation in those sectors, and we've seen how reforms under Operation Vulindlela have been actually implemented. About 80% of the reforms are completed or in progress. So there's a lot that is being done there. Also, when it comes to load shedding, you've seen that, yes, there has been disappointments lately, But if you look at electricity production, it has improved, and the energy availability factor has actually improved quite significantly compared to where we were in 2023, when the economy averaged around 0.7%. We have deep financial markets, we have a lot of mineral resources in the country, flexible exchange rate, which sometimes acts as a shock absorber in times of crisis, but also we have a credible inflation targeting framework, which has managed to stabilize inflation at lower levels compared to where inflation has been before 2000. Before 2000. So cyclically, I think we are poised for an upturn. Domestically, if you look at the leading economic indicator, it has actually been improving persistently on a year-on-year basis. And when we assess the impact, or when we assess whether the probability of a recession or significantly low growth is still high or low, our assessment indicates that that probability has actually come down quite significantly. So we are actually poised for a cyclical upturn, and I will talk about what actually is going to underpin that cyclical upturn. So our latest GDP growth forecast suggests that, yes, last year was a disappointment in terms of economic growth. GDP averaged around 0.6%, which was even lower than 0.7% in 2003. But the biggest impact to this was really the agricultural sector, which contracted quite significantly by about 8%. And conditions in that sector now appear to be improving. The latest quarter four GDP data indicates that gross value added in the agricultural sector rebounded quite strongly in quarter four by about 17.2% quarter on quarter. And agricultural economists have told us that conditions or economic activity in that sector is going to improve going forward, because first of all, the weather conditions are improving, but also issues of animal diseases and all of that have been sorted. And we've seen also business confidence within the agri sector has actually improved quite significantly, indicating that businesses within the sector are quite positive about the outlook. So we're thinking that the economy is going to actually gradually lift to around 1.7% this year, slightly below what Treasurer expects at around 1.9%. But what we know from the budget is that Treasurer did not include in their forecast the latest GDP numbers. So that 1.9 could be revised when the MTPPS is being tabled in October. But I must say that it's possible for South Africa's GDP to still be closer to 2% this year alone, simply because we think that inventories are going to drive the recovery. So there has been inventory destocking over the past 2 years, and we think our analysis historically indicate that after destocking for about 4 to 6 quarters, you start to see some restocking again. So that is going to be important in terms of driving economic growth. So we have 1.7% this year, lifting to 1.9 and 2.1% in the 2 outer years. Some of the factors that are going to support this kind of economic growth include stable and low inflation. So our inflation is expected to remain lower, even lower than last year, and that is also the view of both Treasurer and the Reserve Bank. But also interest rates have come down, and business and consumer confidence has gradually improved. So all of those factors are going to support economic activity. We're starting to see some reduction in terms of structural constraints or supply side constraints, particularly load shedding and what is happening in the logistics sector. The 2-pot retirement savings withdrawals are going to be positive, although those are going to be maybe outweighed or offset by the impact of a VAT increase. But also I must say that the budget, as Davi said, is not passed yet. So it's possible that the VAT could be reversed, or maybe if it increases, it could increase by 0.5% instead of 1% over the next two years. So it's not passed yet. I think this slide speaks for itself. If you look at what has happened in terms of confidence, particularly since the formation of government of national unity, it has actually improved quite significantly. And even the confidence of automotive or new vehicle dealers has actually improved quite significantly. Lately, you can see it's sitting over 40 index points, indicating that conditions within the automotive sector are actually improving. And this is not surprising because interest rates have come down. Yes, not enough compared to what has happened when they were going up, as Ghana said, but I think the data speaks for itself. If you look at new vehicle sales, they've been growing quite decently, particularly passenger car sales at double digits, and you will see the slides there. So I think that that is going to be positive for the automotive sector. If you look at investment plans, they've also increased to around 445 billion compared to where they were in 2023. So this is usually an indication that businesses and government are likely going to spend more on investment. And if that happens, that will be positive for the economy. Consumer confidence, you can see it has also been improving. Yes, still in depressed levels, but much better compared to where it has been in late 2023 and early 2024. And if you look at consumer spending on retail and retail goods, you can see it's been growing quite decently because we're starting to see this improvement in consumer fundamentals, particularly if you look at the consumer balance sheet and if you look at income, particularly labor income and even net worth, you can see that that is actually starting to improve for the consumer. This is the slide I was talking about. If you look at what has happened in new passenger car sales, you can see that it's been actually, the outcome has been quite positive over the past few months, growing quite positively in double digits. Obviously, commercial vehicle sales are still in negative territory, but we think that that too could actually experience some upturn, particularly if we continue to see these reforms being implemented and more infrastructure investment coming into the system. And yes, the budget indicated that they're going to spend about 46 billion more on infrastructure, so that should be positive for the economy and for the automotive sector. I think what is also interesting about this slide is that last year, yes, was not a good year for the automotive sector, particularly if you look at the rand value of new passenger car sales, which is the data that we get from Stats SA. It does indicate that, that the rand value of new passenger car sales declined by about 7.3% in 2024, whereas if you look at the used vehicle sales, the similar indicator indicates that that value was up by about 4.7% last year. It does indicate that when the consumer is in not good position, they still want to buy cars, but they choose cheaper cars. And the first thing they go to is the second-hand market, right? But we think that as things improve, then those consumers and even new consumers will start to participate more in the new passenger car space, because it's always good to drive a new car that is reliable, and the data speaks for itself. It indicates that new passenger car sales performance is starting to improve. And our analysis of historical relationship between interest rates and new passenger car sales does indicate that whenever interest rates begin to come down, you start to see this positive response from new passenger car sales. So we think that that trend is going to remain intact even in this current economic cycle. The consumer, as I said, if you look at disposable income, it has actually shown some signs of stabilization and improvement. Net wealth, which is household assets minus liabilities, you can see that has improved quite significantly, indicating that consumers' balance sheet are beginning to strengthen a little bit. If you look at the data from South Africa's Rewards Association, you can see that the way in which wages have been increased across sectors, it has actually been above inflation. So for unionized staff, it was about around 6.25%, and for CEOs, it was around 5.7%. But the point here is that increases in wages have been above inflation, so that should support consumers' purchasing power. Yes, some consumers across the income band are still going to be in a tough situation, but I think generally at an aggregate level, you're going to see this improvement in consumers' fundamentals. And I think what is the challenge, even though cyclically we're beginning to see some improvement, I think the challenge is that the economy is not growing fast enough to generate more GDP per capita. So if you look at our GDP per capita, yes, it has increased, particularly quite strongly between around 2002 to just before the global financial crisis. And then after that, it started to move sideways. And then came COVID, it came down, and it has never reverted to pre-pandemic levels. And it's still even below 2013 peak of around 18,191. So this indicates that the economy is not generating more wealth in the country. The living standards are not improving at a pace that one would like it to improve. And I think that this is where economic reforms become more critical, because we need to make sure that we have stronger growth than population growth, so that this indicator will start to improve and that we start to experience more inclusive growth. But also what is interesting in this slide is that the majority of households or individuals earn below let's say 500,000 per annum. And I think that's quite critical for an automotive sector like yours. So if you look at the 0 to 100,000 band, you can see there's about 6.6 million people in that band who earn a combined income of around 283 billion. So per person is about 43,000 per annum. That's really little. You can't participate in an automotive sector with that kind of an income. But if we try to improve our economy and make sure that it's more inclusive, we probably could move those people from that low income bracket to a higher income bracket, and you can start to see them participating more in the automotive sector. Another thing is that you've got about 5.8 million individuals who earn between 100,000 to 500,000. So that's a lot. And those people, their combined income is about 1.4 trillion, which is about 40% of total taxable income. So you can think of those consumers as consumers for affordable new car market. But you can see that it's a lot of people that are actually concentrated in, let's call it low income bracket, and only about 2.1 million individuals who earn between 500,000 to 1.5 million earn a combined income of around 2.1 trillion, or up close to 60% of taxable income. So you can see the dynamics here in terms of the customer base that you are dealing with domestically when you look at consumers per income brackets. As far as headline inflation is concerned, I'm about to conclude now. We've seen domestic inflation coming down quite significantly, assisted by a significant fall in fuel prices, as well as a significant fall also in food prices. Core inflation is currently sitting at around 3.5%, which is manageable, and we think that inflation is going to average around 4% this year, down from 4.4% last year. That should allow the Reserve Bank to ease more. However, there are risks related to what is happening in the global economy, particularly when it comes to Trump. And I think that the VAT increase also now is going to be part of the risks that the South African Reserve Bank is going to be monitoring very closely. So our view is that there could be some scope for 2 more 25 basis point cut to leave the repo rate at around 7% by end of this year. So initially we had a 25 basis point in March and another 25 basis point in July, but we have shifted that a little bit out. So the March cut is now moved to the May MPC meeting, and the July cut is now moved to the November MPC. This is to allow the Reserve Bank to assess the impact of tariffs, and now even more the impact of VAT on inflation. But we are not saying that the Reserve Bank is not to cut anymore. So it's still going to cut, and the level of the repo rate will be at around 7%. If it wasn't for the fact that we think that the Reserve Bank is going to move to a lower target ultimately, especially from around June next year, interest rate will be at around 6.5% at a terminal level. So we've got that 50 basis point premium, which we have left there embedded in the terminal repo rate, to just take into account the fact that interest rate will need to be a little bit higher for the Reserve Bank to be able to effectively move from a higher 4.5 midpoint to something lower than that in terms of inflation target. But what is positive is that while interest rate might be relatively higher to get there, what is positive is that once inflation is low beyond that point, then it will allow the Reserve Bank to cut even more, which will be positive for the automotive sector. I'm sorry, I can't see my slides here anymore. Is it a sign that I must stop? Yeah. So I don't know what's happening. But the slide that I had here that I think was interesting to talk about is a slide on the progress on economic reforms. If you look at our energy availability factor, it has actually improved quite significantly. Electricity production or generation was higher last year compared to 2023, which indicates that the Energy Action Plan and the Operation Vulindlela reforms are actually working. Government, we know, extended a lot of money to Eskom to try and make sure that Eskom manages its balance sheet. and that they do a lot of maintenance to try and make sure that the issue of load shedding is sorted. So we've seen some progress on that, but also we're starting to see some stabilization when it comes to the logistics sector. If you look at, there you go. Here, if you look at freight transportation by rail, there has been some marginal improvement. So we're starting to see some signs of stabilization in the logistics network. And we think that the implementation of the freight logistics roadmap through the National Logistics Crisis Committee is also going to be critical to make sure that conditions in the logistics improve. And if you look at the budget, it says that over the next 3 fiscal years, just over 1 trillion will be invested in infrastructure. And about 400 and something, just over 400 billion of that is allocated to the logistics sector. So you can see that government is really determined to improve conditions in the logistics sector so that does not become a constraint anymore to GDP growth. I think this slide speaks for itself. Reforms that were done under Operation Vulindlela 1, I've spoken about them already. And government is continuing, is moving into ensuring that the local government is also strengthened and service delivery there improves. They're moving towards digitization and ensuring that we create dynamic cities. So all of those reforms are really going to be critical. And the good thing is that there is no party within government of national unity that disagrees with these reforms. So everyone is united behind these reforms, and everyone wants to implement this reform. And I think the GNU is going to last. I think it's going to last beyond Ramaphosa's term. I don't think Ramaphosa is the only guy who's keeping GNU intact. I think all the parties that are within the GNU want to be there, whether Ramaphosa is there or not, because it is cold outside of the GNU. They want to be seen to be making an impact, and also do not undermine the power of Paul Mashatile, to be honest. Paul Mashatile, yes, media may not like him, but he is the guy who actually got rid of Zuma. He's the guy who got rid of Zuma, and Zuma was seen as a corrupt individual, not good for the economy. And so from a business perspective, he might be a good candidate. And even from a GNU perspective, he might be a good candidate to keep the GNU going. But I don't think that the GNU is centered around one person. Personally, I don't think so. I think that all the parties want to be part of the GNU and want to make sure that this country works and this country moves forward. I think this is the last slide, which just indicates our exposure to the US in terms of trade or exports. US is a very important export destination for South Africa's commodities. Our first major trading partner is China. Obviously, in 2023, we exported about 11.2% of our exports to China and about 7.6% to the US. So US is quite critical. And if you look at the type of commodities that we export to the US, the chart on this one, my far left, you can see that we export about the top commodities is your precious metals, followed by vehicles, products of iron and steel, which are now facing tariffs, mineral products, and then agricultural products. So those are the top 5 commodities that we export to the US. And in terms of AGOA, obviously transport equipment, largely vehicles, and other related automotive products. Those are the major products that we export to the US. Yes, from a broader economy, when AGOA goes away, we don't have a view of whether it's going to go away or not. But when it goes away, the impact is around 0.5, 0.6% on GDP. But on companies that export to the US through AGOA, the impact could be significant. But it doesn't mean that once you are kicked out of AGOA, you cannot export. You can export, just that you will export at maybe at a higher price, and you can even divert your exports to other regions. So I think that's my story. Global economy stabilizing at around 3.3%. Interest rates are going to come down. Inflation has come down. What clouds the global economy is what is happening in terms of tariffs in the US. Domestically, we are poised for a cyclical upturn. We expect growth to be around 1.7, lifting to above 2% by 2027. We will monitor the risks of what happens in terms of the budget, in terms of VAT. But I think we are in a good space. Yes, 1.7 is not enough. As Ghana said, we need more growth for us to be inclusive and for GDP per capita to start to improve. But I think if you look at where we came from at around 0.6, 0.7 in the past 2 years, I think lifting to above 1.5 is encouraging. Thanks a lot.
Okay, thanks, Thanda. So if you don't like what someone tells you, bring your own person, right? And then give them the slides. So it was important for him to say 1.5 for me a few times. But on a serious note, so we are grossly behind time, so I'm going to try and push through and carry maybe a few themes into the conversation. So I think what comes out of the, before I go there, sorry. What kind of comes out from at least our assessment is that you're still going to have slow economic activity relative to what we require to be able to absorb population growth. We are still of the view that albeit interest rates do come down, they still kind of remain at a elevated level than what they were kind of pre-COVID. So the cost of funds still kind of play out to be higher. With reducing inflation and with increasing earnings at a household level, at a lower cost of funds, we do see that that does play out quite positively to household income statements, at least in the short to medium term. And you'll start to see when you start to track market data where you're starting to actually see a turnaround in customer affordability levels. All right, so this stuff you can actually, it's not what I'm saying, I'm actually picking this out from independent sources. So just look at this graph. This effectively just talks to what's happening in kind of global market and how things are starting to change. And I mean, you can cast your eyes on how brands that brands like Jaguar Land Rover, you look at Nissan, so that global dynamics are quite volatile at the moment. Okay, so there's a lot of activity. Chinese brands are coming in strong. I think I've mentioned a bit earlier, but you're equally going to see, the likes of Tata that has been now announced through the Motors relationship. That's also coming back. Geely has been announced, and so if you start to listen to the conversation around price point, you can actually see it's going to be highly contested. Kind of that sub 500 is going to become actually very, very competitive to be able to make a meaningful change in there. We've seen what happens with the likes of Suzuki. I think there's no question about that. We've seen kind of the contingent that's also coming that had not reported in kind of Jetours, etc. So I think the point here is the dynamics are changing at a global level. And then if you look at the next slide, and you just take from a production perspective, just track India on this graph and see where India kind of goes, right from the bottom at 1.2 odd, and see where they land. And you can almost understand that not all those vehicles are consumed in India, as I've said. And look at the likes of Mexico. I don't know if any of you would have thought that Mexico is becoming a key player. But if you look at the contribution of Mexico, they actually coming up. If you look within the continent, you look at the likes of Morocco, you look at the likes of Egypt. So what does this say? I think Martina spoke a little bit about kind of the environment in which manufacturers trade and the extent to which that becomes attractive. Is that unless certain decisions are made quickly, it is becoming highly contested in the continent. And so I think the risk we run in South Africa is effectively being flat-footed for too long and run kind of the risk that the likes of Botswana has run over the period. So I think if you kind of get a sense here, and it's not a South Africa issue only. The Japanese are sitting with the same dynamic. Germany is sitting with the same dynamic. So I think we must also just be very careful to now own this and kind of say, oh my God, it's a South African problem. Yes, South Africa is pronounced because we require it as, automotive is a significant contributor to GDP. So I think we need this to fire on all cylinders to ultimately make sure that we can be able to protect, what we all believe would be a very meaningful industry participant. This really just talks largely to EVs. I mean, again, Martina spoke a lot about EVs, etc., and where this goes. If you look at it at a global level, at 2019, kind of like you see that spike into 2020 and just out of 2020. But if you look at the last 2 years, you almost can see that it stabilizes. So even at a global level, albeit you've kind of seen this initial take-up. It's stabilized. And with the markets kind of, let me just say, in the markets where we've kind of got partnerships through some of the manufacturers, you've almost started to see a slowing down when you take out some of the incentives. Okay, so the jury's out as to the extent to which the growth continues. Is it going to disappear? No. Okay, so I don't think we can wish this away. It's not going away. However, I think the question here is around the pace at which it, of course, picks up, the extent to which, if you think about it in the South African context, I mean, we've also almost grown quite significantly, albeit the base is low. Yes, we registered about 1,000 proper EVs in the previous year, but I think all in all, if you add plug-in and traditional hybrids, it's over 14,000. So I think if you just look at the breakdown here, you almost can see that the contribution of pure EVs relative to the alternatives is coming down, albeit the absolute number is going up. Okay, so effectively there is a faster paced growth with the other aspects of plugins and traditional than what you have seen with EVs. But EVs are still coming out. I mean, I think the questions were asked, do you see it growing? I think my view is I think it does really does continue to grow. I think the issue of price point does tend to shape differently when you start to see the likes of this BYD coming in and other parties saying that they probably want to play into the market. How quickly they're able to scale on the back of some of the concerns in terms of infrastructure, in terms of range anxiety, etc. And I think the points have been well made. I mean, I think when we talk about EVs, I'm not going to get into the whole whether is it correct for it to be plugged into a household that's cold, etc. I think that we can have a debate about. But I think as a feature in automotive, it's going to become a little bit more prominent over the kind of decade that we're going into than what we have seen previously. So as you think about businesses, I think Martina was right. When you're looking at your businesses and you're looking at kind of the sources of income and generation, if you are not factoring in the fact that the construct is changing, you may just find yourself a little bit on the back foot. Why is also these things becoming quite pertinent? I think we've spoken about the pressure on the consumer, we've seen it, but this plays through into the total cost of ownership. Okay, so there's quite a few stats that we've got in there, but I mean, at the bottom, we've got a VPI graph that I think we just try and somewhere here. Okay, it doesn't really show well on this digital screen, but we track that across multiple manufacturers on the Wesbank database, and we track what it is that is being financed. Now, that is not necessarily reflective of the retail price. It's what we have financed for that particular vehicle. Now, when you look there, most dealers are party to that stat because of over allowances and all the stuff that we load. So equally, when we talk about the cycle of trade-in being pushed out, I don't also think we must ignore our own behaviors as to how we structure deals. I hear this a lot. People say, but if I don't do it, the guy down the road is going to do it. The reality of the matter is, if there's more people not doing it, over time, we can only just hope that the system washes out those that are. Because the reality of the matter is we can only push our term for so far. All right. So at the moment, I think there's a whole, Brendan was talking about the fact that it's moved from 5 years, 6 years, 7 years, 8. Before you know it, you can actually get a title deed with your car. All right? And we've got problems already. So all I'm simply saying is, as you go back to your businesses and we look at the banks and we look at the macros, let's also assess our own conduct in how we structure deals for customers. Customers are going to take the deal if they're looking at the installment. Remember that. We've shown you the income components. So if you can get the installment down, guess what? They'll take it. They're going to come back in 4 years. You can't get them out. You load. And this whole thing just inadvertently becomes a balloon if you just CAGR what it is that they have to pay in compounded interest. Okay, so this just comes out. The other graph just talks around, albeit customers do keep cars longer, the cost of maintenance is equally going up. Right. That's also largely driven by the parts. I mean, we've seen rand, dollar, import costs have gone up, value chain expenses have gone up. So it's not necessarily the fact that it's becoming cheaper to run a used car. It's just that it's cheaper than buying a new car. And so that cost is a bit spread out, and you probably pay it once when the car is broken versus baked into the installment. I spoke a little bit about this PRISM score. So effectively, this is just the quality of health of a customer. Now, you can see that this has been coming down for quite a while. It's not maybe as clear, but if you look at this point here, I mean, you can almost see we bottom out, but you can start to see that come back. you haven't seen that bounce back. If you just track this graph all the way back, oh, well, forget COVID, most of us couldn't spend, so we're all distressed. So there's this V kind of bounce back. But throughout, as you're starting to see, you almost start to see how the health, the credit health of customers is coming back, right? That's very positive for us because it actually starts to say we haven't baked in the 2 interest rates reductions in there, but we're already starting to see that almost the credit health of customers is better. That means the default propensity is better, right? Now, we're seeing that EPSA-I are higher than what they've been year on year, but we're also seeing a healthy throughput, so conversion. So there is a better vibe in the market, and I think Thanda talks about the fact that dealers' confidence is up. I think it's because you're selling more cars. But the reality is, as you do sell more cars, the ownership story becomes, I suppose, front and center because you guys are also experiencing margin pressure. There's no question about it. A lot more competition, it means you've got to give away margin to be able to sell the car. So what we have now kind of just also looked at as well is, if you're thinking about this as a value chain, what are some of the offerings we need to now delve into as Wesbank to try and make sure that we augment customer affordability? This is very important for us because if customers' health remains intact, then they can pay us the installment for much longer. All right. So I always make this joke with dealers to say, my problems start when you celebrate a target. The month you say you've made target, we start kneeling, hoping, and praying. For the next 72 months, we can collect. So very desperate markets, right? It's very, very different. And so we've got to make sure that we inject some air into the customer's lungs through the ownership cycle. But this becomes important because this becomes an opportunity for us to partner with you. You've got the bricks and mortar. Clicks and mortar is definitely going to come up. But where could we partner across the value chain, leveraging your existing infrastructure to reduce the cost of ownership? The reality of the matter is whether we partner or not, customers are going to need tires. It's simple. Now, they're either going to come back to a place that gives them a proper, compelling value proposition or not. It's a simple thing. Customers are going to have to renew their licenses. And so I think the sooner we can get them out of funding mixes that have got a higher cost of funds, such as credit cards and unsecured loan, we equally aid their health through this process. So, I mean, I'm not going to get into too much of this, but I think it's important that we almost just get an understanding as to how could we partner differently across the ownership cycle versus just the sales transaction. I think this is a very interesting and telling slide. The cost of doing business is actually proportionately higher for the sales that you do. So the days of the Taj Mahal are going. Okay, so if you look at what's kind of, this is what you're seeing now. You're kind of seeing everyone living nicely alongside each other, all right? So if you haven't invested, I think, a colleague of mine, Colin, talks about, the biggest growing business should be drywall in dealerships. So if you're not in the drywall business, you're in the wrong business because drywall is coming up. I mean, you start up here and it's like this and then, so this here could be like 4 dealerships, right? And we just simply say, but it's all different in the back. But at the end of the day, guys, all I'm saying is the dynamics are changing. And so as you think about the brands, if you think about the franchises, you think about the mix, the reality of the matter is as margin comes under pressure, as competition increases, we are going to see a very different relation. Now, it's going to be interesting. It's going to be very interesting when you're now starting to see some of the expansion of Chinese brands alongside other brands where historically you'd not have seen them. It's going to be very interesting. We're starting to see some of the manufacturers kind of also dealers giving back. So this is going to happen more and more. So watch the space, and I think the economics will, of course, have to make sense. In that talks to this whole customer lifetime value solutioning. This is really just around, as we do all this, unfortunately, we have caught the attention of regulators across the world. I think Martina spoke about brand. The brand of automotive across the world is not a pretty brand. Okay, so we're not necessarily seen as a go-to employer. We're not seen as the most TCF-friendly kind of industry and sector. And in the UK, there's been a recent ruling against the banks. Why I know this is because FirstRand owns a bank in the UK called Aldermore. And the long and the short of it is the outcome says that dealers are credit brokers and so therefore have a fiduciary duty equals to that of the bank. Now, guys, this is a fundamentally important consideration. At the moment, we see dealers as agents, but independent of the bank. if this ruling stands, effectively it says that dealers assume the same fiduciary duty as that of a bank. And now it starts to play fundamentally into the remuneration. I mean, DIC here is in question. We've had to provision quite substantial amounts. I think it's on the media, over 3 billion pounds. But if you add up in the UK, what sits in provisions in this topic is over 16 billion pounds. This is money that people are waiting, not knowing how this thing is going to play out. So this is a fundamentally important discussion. The ruling has subsequently been appealed. We've been given a right to appeal. It goes to court in April. Okay, so we're waiting to go and see how this plays out. We're quite positive that the ruling was far reached beyond its own mandate, and it's not correct because dealers are not credit brokers. We remain adamant on that. But I think the point of the matter is that anything that starts in the UK normally lands in OR Tambo. Okay, so just understand. All right, it takes a flight straight to OR Tambo from Heathrow, so we import our legislation more often than not from the UK. You don't have to go look far. Go look at FIS. Go look at TCF. I mean, the list is endless. So this would not be the first. What am I saying? I'm saying the conversations that we've been having around what's going to happen with DIC, I don't know what's going to happen with DIC, but I can tell you for free, there's definitely going to be a proper unpack as to how that is constructed. So if your model, your business model, is built purely on DIC, I'm going to go to the next slide. You figure it out. Okay, so not only that, we've also going to have other individuals. Last year, this time, I was standing trial from my uncle, van Sale, around discriminatory pricing. We've got dealers that have kind of gone through certain cases, have lost them, etc. There's going to be a surge in interest in the industry. I mean, we've gone to kind of dismiss this whole thing around van Sale. It didn't even make it to court because there was no evidence. But the point of the matter is, all it does is, on top of a very tainted industry, it adds more noise. So when you're looking at your dealerships, my ask of you, just keep your house clean. There's a lot of interest by the local regulators in looking at that. Data and AI, I'm not going to spend time on. I think Martina covered it. But all I can simply say is that if you properly understand that this is not just about leads management, it's about how you run your organization, how you are able to partner, how you are able to offer preemptive solutions and contextual, you can definitely take advantage of this wave. But if you think it's just about CRM and the birthday, you're going to miss a massive opportunity because I think the conversation now is very different. If you think that, if most of you would remember Mr. Video. If you think that Mr. Video said, Netflix can never beat me because, people want to come and fetch 7 cassettes, beta cassettes, it's a very different model today. You don't have Mr. Video. MultiChoice made the same mistake. They had the infrastructure, but too slow to move. So I think we've got examples here locally where you've got the infrastructure, but we just have not leveraged some of the opportunities. Cybersecurity, I think, all I can just simply say here is, let's just be very careful about the risks that you are facing as you are communicating with customers. So a lot of you would send an invoice with bank details. These things literally there's phishing. Clients literally get hacked all the time. We've got instances where customers have made deposit payments from the bank and it's gone to the wrong person. So what I'm just simply saying is, as soon as possible, try and find means and mechanisms. And most banks offer a secure line where you effectively register as a preferred like COJ, etc. You can just pick on the list. Minimize your risk. The way in which you converse, encrypt your communication, because most people are now exceptionally vulnerable when it comes to this. And remember, when this notion happens, it's now the fight. You say to the customer, I didn't get the money. The customer says, but I sent the money to you. And so I think if we don't deal with this thing, it's definitely got the potential to become another spike. I think I've spoken to this, so I just need to close out. So ladies and gentlemen, thank you I know I've rushed the second part, there's a few things, but I think in the main, a lot of the things have been covered. So in closing, at least my viewpoint is we have come out of a significantly tough time leading into COVID and out of COVID. There has been significant progress that's been made at an economic level, at an industry level. Things feel better, albeit it's still tough. And I think, if we had organized this a year ago, we would be worried what time load shedding schedule starts. Okay, we haven't looked at our watches. We're not out the woods yet, but I think we must take our wins as we move on. That I think is a massive consideration. I think from an activity perspective, we can be exceptionally proud around the sophistication of our industry relative to some of the markets. I'm privileged enough to see a few markets internationally, and I can tell you now, I mean, I don't know how many of you guys went to NADA in the US. Some of the stuff they're saying that they're starting, I'm like, but we did this 5 years ago. Like, what are you talking about? So they've got scale. We've got sophistication. The question is, how do we use that to actually get the scale and be able to move forward? And yeah, lastly, I think from another perspective, I think we always are appreciative of the opportunity to collaborate with industry on topics that sustain the value chain. We play in one vertical, but what we've learned over time, if you destabilize one part, everybody's vulnerable. So we've got a vested interest in making sure that all the pieces of the value chain work. We can all grow the share of the market. Then we can all compete. But we must never get it twisted that I think it's only just about the vertical you are in, because then all of us are in trouble. So on that note, I've just got a video from Wesbank. Thank you very much for listening. And if there's any questions, I will take them before I play the video. And I promise you, I'm not going to beg for questions. I'm going to go questions. This is great. I've got a different approach. If there's no questions, I was excellent. So no questions.
In the vast expanse of time, 56 years may not seem long, but for Wesbank, it's been a ride marked by magnificent milestones and memories. Each destination is just a launchpad for the next inspiring journey. As innovation pioneers, we craft premium mobility-centric solutions that sync with your life. We thrive on being catalysts of change, helping you get from A to beyond together. It's up to us to make sure the wheels of progress never stop turning. So, we dig deeper to enable the heavy lifting. We play our part in getting food to our nation. We stand behind small businesses and empower them to grow. When the power fails, we celebrate you succeeding at business as usual. And when our future leaders find themselves in the driver's seat of their first car, we smile. You see, mobility is not just movement, it's freedom. And it's freedom that unlocks infinite possibilities so that progress meets partnership. Dreams meet drive and journeys meet joy. With us, you're not just moving, you're advancing. Wesbank. We move with you.